Okay, everyone, welcome to our panel here, our discussion, 50 ways to leave your LIBOR, creating alternative benchmarks. Great song. I don't know if Paul Simon will be joining us on teleconference later or not, but we do have great panelists here now. I'll just quickly introduce you to them. Their full bios you'll find in your program. First, we have Tom Broughton, who's chairman and CEO of ServisFirst Bank in Birmingham, Alabama. We have Meredith Coffey. She is Executive Vice President of Research and Regulation at the Loan Syndications and Trading Association. Scott O'Malia is CEO of ISDA, the International Swaps and Derivatives Association. He's also a former commissioner of the CFTC. And to his left is Brian Quintenz, who is a current commissioner of the CFTC. And finally, also joining us is Richard Sandor. He's chairman and CEO of the American Financial Exchange. So let's get started. LIBOR is going away at the end of 2021. But before we get to what's coming in the not too distant future, I thought it'd be helpful to kind of go through LIBOR itself and its quirky history, how it worked, and really why it's been with us for so long. And Richard, I'm hoping you could take this one and take us back to through the decades.
It's really a historical accident, Justin. I mean, what happened was in the late 60s, a group of European banks decided to issue floating rate notes. It was just about when interest rates were going to start moving, and they wanted to make sure that if they moved up, they could adjust the terms of the loan. So they went to the Shah of Iran and said, hey, we want to finance you, and we're going to do it on a floating rate basis. And then they said to each other, how do we fix an increase? Fix is the key word. And they said, let's call each other, and thus was the birth of 350 trillion of derivatives priced off in odd circumstances in the decade of the 60s.
Yeah. So how do we get from that point to this being such a huge part of all of our lives?
Well, having a benchmark, it became clear beginning in the 73 when interest rates started to take off with the first Arab oil embargo, and then exacerbated by the second one, and then Paul Volcker's Saturday night massacre, in which he allowed Fed funds to fluctuate before the Fed funds rate took off, went to 19%. During that time, people wanted adjustable rate mortgages, credit cards, because of the volatility and the big increase in rates. So the rate then became ubiquitous for anybody, big or large, even though it was intended for multinational big institutions. It became widely adopted because rates were moving so dramatically up, and all of the banks needed variable rate assets. And it coincided in '82 with the birth of asset liability management. Hard to believe, Justin, but there was no such thing as ALCO committees in banks in the 70s. It was a new phenomenon, and nobody had ever thought the curve could invert. And that, resulted in 5,900 S&Ls disappearing because of the inversion, lots of banks going out of business. We lost 5,000 banks, and we had 14,000 banks, 6,000 S&Ls, 10,000 credit unions, 30,000 depository institutions. We're down at 360 S&Ls and about 5,200 banks. So interest rate risk management is now critical. Nobody would ever go into a bank and not think about how do you match assets and liabilities.
Gotcha. I'd love to kind of flash forward now to the aftermath of the financial crisis. Scott, can you kind of pick us up from there? What happens? What is discovered, and how does it lead us to the current situation we're in?
Well, the CFTC, there was some concern during the financial crisis why LIBOR was so low in terms of the price. And there were a couple of news articles that have been written kind of unpacking the issue of if bank credit is such a problem right now and they're not lending, how is the rate remaining so low? So the CFTC staff began to investigate in around 2008, 2009, and collaborated with the FCA in the UK in terms of investigating this and looking at it. And then slowly but surely we began to unpack tapes and recordings and emails and chats that exposed manipulative behavior. So in, I think it was 2012, those investigations resulted in some new orders, which ultimately resulted in about $2 billion in fines and penalties being assessed to firms for manipulating LIBOR. Collaborating with other colleagues across other banks to fix the LIBOR in a manipulative behavior in several currencies and in several jurisdictions. So this was a global problem. The CFTC and other agencies in the U.S., as well as colleagues across the globe, all stepped in to enforce this. And as a result, it became clear that LIBOR the survey model was broken and flawed and subject to manipulation. We assessed penalties and set behaviors, but in the wake of that said we need a new system. We need transaction-based, observable, transparent process in order to make sure that we have a good, robust LIBOR rate setting process. And using IOSCO, the International Organization of Securities Commissions, they went during a process in 2013, collaborated with other regulators to set high standards for what benchmarks would be used.
Sure. So I'm a reporter, so I love these to sort of ferret out the anecdotes here. Can you kind of talk us through the moment you realized that there's this major issue that was, again, that had such great consequences to so many investors, so many lenders, so many borrowers around the world?
Well, we didn't know for sure, and this was in 2008 when the first articles came out.
Sure.
They were trying to reconcile the low stable price of LIBOR during the financial crisis, and that was not consistent with where the banks were in terms of their financial exposure. So we were trying to put that together and understand how that could be, that bank lending remained totally stable and at low rates while the crisis was going on. So it took several years to investigate this process and unpack the questions and find the evidence to enforce this. Mm-hmm. So it literally took, I guess in 2010, 2011 is when we really began to collect really serious evidence. And it was in 2010 that we actually issued an order to all the 16 banks saying, we need to audit your process for this. And even then, during that time, the banks were still continuing to submit faulty prices, even though they were under investigation, which was quite remarkable.
Gotcha. So just sort of going to maybe the next chapter here, when do regulators and when do other participants and constituents recognize that we need to think about replacements?
Sure. And I'd actually add something to what Brian said. It wasn't only billions of dollars of fines. People went to jail. Including last month. So there's nothing like an impending jail term to focus people's attention, I think.
Right.
So how have things begun to change? When did regulators shift their focus? I think the initial question you asked was, when did regulators decide to force LIBOR to go away? And I don't think that's exactly right. I think there was a lot of work to fix LIBOR. Could there be more submissions? Would banks lend to each other more? And ultimately, I think what was determined was there just isn't very much interbank lending. So as an example, in US dollar LIBOR, there are $200 trillion of contracts that are priced daily off of US dollar LIBOR. There is $500 million of daily 3-month LIBOR trading. So that $500 million of trading gives banks information to allow them to create expert judgment to determine what LIBOR is. They submit those quotes to the ICE Benchmark Association, who then aggregates it into a curve that's published. It prices $200 trillion of contracts. It's not stable. there isn't going to be more interbank LIBOR-based lending. So I think ultimately there was a recognition, as Brian also mentioned, that you have to go from this auction process or this sort of indicative quote process to something that can actually be foundationally based in data. So I think the regulators recognized, they didn't say, oh, we have to end LIBOR. I think instead they said they tried to fix it for a long time and then ultimately decided it probably couldn't be fixed. So that was, I'm assuming, a sad day. Our sad day in the cash products came in 2017 because in the cash products, the derivatives products were much further ahead along this process than we were. In the cash products like loans and bonds and things like that, there was quite an awakening in 2017 when Andrew Bailey announced that the FCA was no longer going to compel banks to submit LIBOR after 2021 and that LIBOR might go away. At that point, all my members woke up and said, wait, what? LIBOR going away? We have to do something. So that was our sort of awakening.
Gotcha. And Brian, if I could ask you, how do we get to that specific deadline for the start of 2022?
Yeah, I joined the commission in August of 2017, so it was 1 month after Andrew Bailey made that speech. And from what I was able to determine, it's a similar result, but maybe a little bit of a different cause of his rationale for doing that. After 2013, LIBOR came under the FCA's purview. Before that, it was just independently published. And at the same time, the EU issued a benchmark reform piece of legislation that, when applied to LIBOR and designated LIBOR as a critical benchmark, the ability to compel submissions for a critical benchmark became very limited. So what Andrew Bailey said in his speech was that he was able to get an agreement among the banks to voluntarily submit for the next 4 years to try to keep LIBOR alive and lengthen the runway so that an early transition could take place. Given that his powers to compel submission were limited, I think everyone viewed 2021 as a regulator-imposed deadline when in fact it's really just a jurisdictional issue. Mm-hmm. So regardless of how it came to be, I think the final say in the matter is that post-2021, from a regulatory perspective, it would be difficult, if not impossible, to recognize LIBOR as having an active market under the principles for financial benchmarks that Scott mentioned was published by OSCO and was endorsed by the FSB and the G20. At that point, I think regulators will no longer recognize LIBOR, which means there are going to be massive ramifications for the derivatives market, the ability for those contracts to be traded, actually the complete lack thereof, which means hedging tools for cash contracts based on LIBOR go away.
No, thank you. And maybe just a good time to kind of step back and remind folks what's at stake for all the different parties here in terms of getting this transition right. Starting with Tom, I just want to ask you why is this such an important process, and what's changed for your institution? How are things changing as a lender?
20 years ago, pretty much all of our loan portfolios for the large community and regional banks were tied to prime. There's been a huge shift over the last 20 years away from the corporate treasurers like LIBOR. They don't like it when there's times of economic stress, but they forget about that. They wanted to go away from using prime as a reference rate, and we've tied them to LIBOR and all the swap contracts that go along with our loan portfolios.
Gotcha. And Meredith, you talked about it from the larger banks, from the leverage lenders.
Sure.
What's at stake?
Sure. So to give a little bit of context, we represent sort of the large money center banks, the large regional banks, and the large asset managers. But I also co-chair the Arts Business Loans Working Group along with the ABA. So they bring in the smaller regional banks, they bring in the community banks. We actually have borrower representation. So there is a wide view on that. I would say from their vantage point, there's a couple things they're thinking about. The first is the size of the problem, and the second is the complexity of the problem. If we think about size, there are $4 trillion of U.S. syndicated loans that are tied back to LIBOR. $4 trillion with a T. There's also about $600 billion of CLOs that tie back, and I don't know the amount of bilateral loans that tie back to LIBOR. So it is a very large exposure. So one, size is an issue. Secondarily, the other major issue is it's complex. So as you move from LIBOR to a new replacement rate or a successor rate, it's going to look different. As it looks different, you have to think about how you're lending, how that changes. Do you have basis risk? Can your systems actually operationalize a new rate? So it is very complicated. Now there's good news and bad news in that. The good news is we have some runway. We've got a couple years. The bad news is it's so large and complex, a lot of people just kind of want to ignore it and pretend it's not happening because it is so big and it is so daunting. It's sort of like death. You just don't want to think about it. But the reality is it is out there. And I think people are beginning to accept that they need to execute on it.
Gotcha. And then, Scott, if I ask you about the derivatives market.
Well, $4 trillion is a lot of money. The derivatives
He's going to make
market,
fun of how small my market is.
derivatives market kind of is the aggregation and the hedging tool for all of these markets. And there are over, excuse me, $370 trillion in LIBOR-related contracts. 80% of those are swaps and derivatives, hedging tools for all of these other markets. So it's very significant. And we therefore need both a transition strategy and a fallback strategy. Many of these loans, or many of the loans, and therefore the hedging tools, have 30-year durations, potentially. So you have LIBOR embedded in these contracts. You need to think about a pathway forward because 2022, 2021, when it ends, potentially, you need a strategy in order not to have a destabilized contract. You need to have a price in your contract that you can continue to work for. So there's three important work streams that we need to be dealing with. One is the transition to risk-free rates, and we haven't really talked about what the alternatives, SOFR, SONIA, et cetera. We'll get to that, but we need to get off of LIBOR and get onto these new risk-free rates. The other part is to replace LIBOR in the existing contracts, the legacy contracts, so you have a price and you don't have contract frustration going forward. So ISDA has been asked by the FSB, the Financial Stability Board, to address this in terms of a fallback rate. And we've consulted with the market and produced some options, developing a spread calculation between the current LIBOR rate and the new risk-free rate. And we need to figure out how we take that apart, publish that for the market to use, and we want everybody to use it. This is a voluntary process. ISDA can't compel anyone. The regulators are not compelling anyone. We're trying to develop a market-driven solution to replace LIBOR in the existing $370 trillion kind of a set of contracts and replace it with a more stable risk-free rate that is currently on offer. So we're in the process of doing that, and by the end of 2019, we will have in place all of the tools that you can adjust your existing legacy contracts. You can develop fallbacks for your future contracts that don't rely on LIBOR. So you will have in place a safety net post-2021 to ensure that your contracts are viable and you have a stable price that you can execute on.
Gotcha. And maybe, Brian, if you can kind of talk about the process, regulators and industry participants coming together and exploring different alternatives, I guess beginning shortly after that point in 2014.
Yeah, I think there are two kind of broad and important points in discussing, kind of just a brief history of this. One is the unity with which global regulators have taken a very strong position over a long period of time in looking at this issue. And the second is that the rate that was selected was done with and was done by market participants in a public and transparent way. So in 2013, there were two different kind of official sector work streams, one at the FSB and one at IOSCO, that were connected and related but separate. IOSCO ended up developing its principles for financial benchmarks, which ended up saying, as one of the principles from a data sufficiency principle perspective, that a benchmark should be based off of prices, rates, indices, or values that were formed from the competitive pressures of supply and demand, and that they be based off of transactions, arm's length transactions between buyers and sellers. That report was published in July of 2014. At the same time, in July of 2014, the FSB's official sector steering committee, steering group, validated that concept and called for the creation or acceptance of a new interest rate benchmark. That led to the creation of the Alternative Reference Rates Committee, the ARC, at the New York Federal Reserve. That was originally composed of 15 derivatives banks for the purpose of replacing LIBOR in derivatives contracts. So that work went on. It was, there were public consultations that were issued. The ARC presented a range of options, and the one which received the most support and which the ARC most readily embraced was the SOFR, the Secured Overnight Financing Rate, which is based off of overnight Treasury secured repurchase agreements. Meredith was speaking to the fact that in certain currency tenors of LIBOR, there are $100 million of transactions on a daily basis. That maybe on some days amounts to 5 unique transactions that underpin trillions of dollars of cash market products and hundreds of trillions of dollars of derivatives products. There are over $750 billion of daily transactions in the overnight secured repo space. So this was the rate that was selected in July of 2017. And then, coincident enough, Andrew Bailey gave his speech, and the ARC transitioned from having selected SOFR as the rate to developing an implementation plan for both the derivatives and the cash market side. And so that is the plan on which the private sector with government support and advocacy have been executing.
Gotcha.
And actually, I think
please.
one point to reiterate that Brian said, again, $500 million of daily LIBOR trading, close to $1 trillion of daily trading that comprises SOFR. That is a dramatic difference and a much stabler rate.
Gotcha. Of course, there are other alternatives, including one developed by one of our panelists here. Richard, if you could talk to us about your own benchmark rate and how it works.
Sure. We set out with a different track, and what Meredith said and what everybody else has said here. I'm 700 years old, Justin, so I've been knocking around the futures business for a long time, and the first thing you need is a viable cash market. There's no way you can start a futures or a derivative without a viable cash market. We, in 2011, when RBS fired a bunch of traders, said, okay, 3 things are going to happen. 1, LIBOR is going to lose its preeminence. 2, 0 interest rates were not sustainable, and the Fed funds market would reemerge, and the government wouldn't play a dominant role in both borrowing and lending. So we said, let's focus on the 5,364 banks in the United States and leave the 10 big ones out of it. So I used to go to Shanghai and Singapore and New York and Paris, and I found myself in Birmingham, Tupelo, Evansville, Indiana. And we visited 125 small banks, regionals, mid-size, and communities. And they have about $9.5 trillion in assets, and about half of them are floating rate. So we said, this is really peculiar because every other asset class has multiple benchmarks. With crude oil, you've got Dubai, you've got West Texas Intermediate, you've got Brent. You've got more stock indexes than you have stocks. And you certainly have more bond indexes, given munis, corporates, governments, mortgage-backed, et cetera. So our theory of the case was the best thing was to have choice, okay, because and an overnight unsecured rate would fit banks like ServisFirst. So we went around the country, we built up consensus, and we spent 4 years researching. We patented a weighted average based upon transparency. We partnered with the CBO, so we'd have a self-regulatory organization and making sure that there were no spoofings, built a 150-page rule book, and launched in December with 4 banks at the opening, and none of them had credit lines with each other. The big problem was, and Tom can attest to this, even though we had the biggest bank in Wisconsin, the biggest bank in Indiana, they had no credit lines. So the big challenge was to get a network of new credit established. So we had $13 million a day and 4 banks at the opening. And we now have 118 regional mid-sized community banks and 557 communities through a correspondent program. So we have about 700 banks that are members. And we went from 13 million a day to last year 72, and we were trading 300 million a day, and we're up to $1.8 billion a day now. And the average of those on a daily basis is Ameribor. We now have had leaders like ServisFirst and a number of others that are starting to do Ameribor-based loans. And following the model we did with interest rate futures and carbon emissions and SO2, we think it's viable enough, and we'll start a futures and options market. And we have now recruited non-banks. Deere just joined, Cerberus just joined, Jefferies, insurance companies. So we have 26 non-banks, and we're finding a big interest in the corporate C-suites because they price commercial paper off LIBOR, and they're very nervous about doing it. And they're also nervous that once their debt gets placed, they wonder what the implications of swapping it into a different rate. And if that different rate is no good, they get potentially embarrassed because it still sits as their name on it. And they are taking a big interest in the replacement. And we think that's healthy. We should have corporate America, not the financial sector, being involved in decisions about benchmarks.
Gotcha. I want to just ask you, you touched on it in the first of your most recent remarks, why you set out to do this in the first place. What drew you to this particular issue? And obviously you've got a long career of success. Why tackle this issue?
I'm an economist who invents markets, and I like a problem, and I like to fix problems, and so, whether it's climate change or acid rain or interest rate futures, you need to see a structural change that one thinks is going to turn into a major event. And in the case, it was 07, 08. In the case of interest rate futures, it was 69 and 73 crunches. In the case of acid rain, it was whatnot. So we had sold our exchange to ICE in 2010, and we set out to do water markets. And all of a sudden, it just appeared that we should start a new market. Our experience, Justin, is it's a 10-year period. So this was 2011. It took us a decade to do financial futures. Between they did it, it took us 15 years to do environmental derivatives. It took us about 25 years to do cat bonds and things like this. So we started out in 11 and said, okay, this is a decade-long process. We have to build a cash market. We have to build consensus among all of these banks. We have to populate it so that we don't get banks only in the southeast that are growing. We need banks in the northeast that aren't, and the far west. The American economy is rolling regional GDPs, so we had to populate and be in all 50 states so that we could homogenize regional rate differences to come up with a national rate, Ameribor, which reflected unsecured. Most of our banks, different than what we're talking about, own no government securities. You know, so SOFR is great for the major institutions, for levered loans, for the big banks. The Fed's done a fantastic job in building consensus, et cetera. But you got 5,000 banks out there that don't know what a repo is, or, you know, that with $9 trillion in assets. So we were targeted and said, these guys and girls disproportionately fund small businesses and create new jobs. If you look at Jeremy Stein's stuff out of Harvard, or Darrell Duffy and Stanford, the small and medium-sized banks really are the backbone, and they'll lend to the dairy farmer in Wisconsin, or to a car dealer in Tennessee, or to a feeder company for Walmart in Bentonville. And we like to think that these markets, and we've been a big fan and worked on the starting of the CFTC, that regulated, transparent markets would provide not only for the efficient distribution and growth of food, but energy, and now also a benchmark, that they were there to provide a price signal. And that price signal had to be transparent and regulated for it to be a guideline for this particular group.
Gotcha. Sorry, Scott.
Well, I think Richard points out a great point. And this transition off of rates that are not observable, transparent, et cetera, to a more robust rate, whatever the rates are going to be. And we're not here to pick one rate over another. What we're trying to facilitate is the transition. And it's got to work for Main Street, and it's got to work for Wall Street. Everybody's got to be included in this transition. It's got to be safe and predictable. And so, I mean, on one hand, I'm very encouraged by the fact that it's taken a long time by other benchmarks to move this along, because this is a hard problem and it will take time. And we've got a good run at it. And to Brian's point, the regulators are unified on this. The market understands what is at stake and what they need to do. This is not a question of whether we're going to do it, it's when and how we're going to do it. And then we need to really get a good run at it so we can effect a smooth transition and nobody's left with contracts that don't have a price, or that you have contract frustration, you can't execute on your price. So, you know, this is a broad program. We have to bring the corporate treasurers and the chambers of commerce and everybody along this process, because it's got to work for everybody.
Gotcha. Tom, I wanted to include you in some of the things that Richard mentioned. You go back a long way with him. Ask you to sort of share that and how you found Ameribor and how you began to maybe use that rate.
When this first idea came up about the American Financial Exchange, and I get a call, and I had a conference call with Richard, and I said, and then all of a sudden it dawned on me, I said, Richard, you taught futures course at Kellogg School in 1977. He said, yes, I did. He was with the CBOT at the time, and he taught a course on futures, and that's how we became reacquainted again. You know, Ameribor is the perfect reference rate for the vast majority of the banks in this country, because it reflects the incremental overnight cost of funds. If we need to borrow $100 million tonight, we go into the AFX market and we borrow $100 million at a rate, and that would be a rate that we price our loans with in the future. And the beauty of Ameribor, it will closely track the Fed funds rate. And I can look at a corporate treasurer and say, this is a good rate to tie your loans to because it's going to be stable. And the reason it's going to be stable is because Fed effective is set by the Fed, and the Fed effective rate is going to be very stable. And so Ameribor is going to closely track the Fed funds rate. So it is the perfect reference rate. And, the problem you get into with, we've already seen, I think year end 2018, the SOFR rate jumped 70 bips overnight. I assume due to a shortage of Treasury securities, everybody. And, in times of economic stress, Justin, we get to, September 2008, the repo rates dropped to near zero for that month. And the LIBOR rate increased by 500 basis points for the month. So, there's a huge flight to quality when you have these secured rates. They're just not a good benchmark for most banks' loan portfolios. I understand the money center banks, they're as interested in selling swaps and there's more profit margin in swaps than there are in loans. I'm well aware of the profit margin in swap contracts. It's enormous still. You can't get a quote on a Bloomberg machine to see what the markup is in a swap like you can in a bond today. But in any event, that's why we think it's a wonderful reference rate for Ameribor for our purposes, not for every bank, not for the money center banks, but for the vast majority of the banks, the large community and regional banks.
So how have you started to use it? Have you started to transition off of LIBOR?
Yeah, and we are using it, and and when we have a corporate treasurer say, well, it's a new reference rate, I said, well, LIBOR's going away, and most bankers are I think Meredith's right. We're going to worry about this later. LIBOR's going away, but that's tomorrow's, next week's problem to deal with. So.
Until it's a really, really big problem.
Until it's a really
then
big
it's their problem.
That's exactly right. Yeah, I think one of you made a reference to Y2K on the phone. We were all thought the world electricity was going to stop flowing, perhaps. But there's a pretty good chance there's going to be some problems, I think, with a lack of a very good reference rate.
So I'm sorry. So have you started to use?
Yes, we're
Ameribor
pricing loans today off Ameribor. We're tying them to the overnight rate, and it is working very smoothly. The rate has proven to be, it is now approached just very close to, over the last 6 months or so, it's been about 17.5 basis points higher than LIBOR on average. So we're pricing loans off of it. And we can look at a corporate treasurer and just say, look, if there's a problem with this, we'll fix it. I mean, that's not, we're not, if it becomes a problem, but I cannot imagine where the rubber's going to hit the road is in times of economic stress. And until we get in times of economic stress, we're not going to know what's wrong with SOFR. And then we're going to find out what's wrong with SOFR when we get into, because it is a secured rate, and there'll be a flight to quality when there's times of economic stress.
I'm just curious, when you talk to corporate treasurers, other borrowers, and you introduce a different reference rate, how do those conversations go? Do they say, well, can we just stick with what we know, or are they at a point where they recognize as well the looming deadline?
Probably the larger corporate treasurers want to stick with LIBOR for the time being. Typically, our ideal client for our bank is an owner-managed company where the owner makes a decision on what to do. Those are the people that they're not always chiseling us on price as much as the corporate treasurers are. So the corporate treasurers are counting their pennies a little bit too closely for me.
Do they ultimately accept, or do they say, well, I'm going to shop around, or how do you navigate those negotiations?
We're starting with people that we have a close relationship with, and we have a friendship, long relationship with. They trust us. Those are the people we start with, and we don't participate. We have very, very few shared national credits, which are just not a market we're interested in. So we like dealing with our own customers.
Gotcha. And Meredith, how are things going in terms of your constituents?
Sure. I mean, I think, so I would say you need to look at it we're speaking with SOFR, not Ameribor, I believe. And you probably want to look at this in a couple ways. How's it going in the derivatives market, which is much better position for Scott to talk about, and then I can talk about what's going on in the cash markets.
Sure.
In the cash markets, I'd say it's been going pretty well. So SOFR as a rate was introduced last April 2018. Starting in June, people started issuing SOFR-based notes. So literally funding their liabilities through SOFR. There's been more than $80 billion of SOFR floating rate note issuance done so far this year, since actually June 2018. There's been, as far as I know, there's been no SOFR-based loan issued, but actually I know a number of institutions that are working on it. So there is definitely work going on. I think one of the things that's very interesting around some of the SOFR issuance goes to a point that both Tom and Richard made, which is asset liability management or basis risk. So who's been issuing SOFR-based FRNs? Fannie Mae, Federal Home Loan Banks, Wells Fargo, JP Morgan. They are issuing that, and that's just going to be their liabilities cost. So somebody like Fannie Mae can on-lend based on SOFR. Somebody like the Federal Home Loan Bank system can on-lend based on SOFR, which means then you're in a situation where the liabilities, the cost of funds is SOFR-based, so people would be more inclined to lend on a SOFR basis. Basically, you've gotten rid of the basis risk or the asset liability mismatch. So that actually leads to more lending to communities based on SOFR. The other thing I would add on SOFR, and Scott can get into this in a moment, is it's actually kind of important from a borrower perspective because where the vast majority of hedging capability in the future will be is with SOFR. If a company wants to borrow a floating rate and then hedge to go to fixed rate, that will be easiest and cheapest on SOFR because that's where the derivatives markets are going to be. So there are many places where if you are managing your assets and liabilities, SOFR actually, some of the developments that are going on SOFR are actually very constructive.
Gotcha. You mentioned there have been no SOFR-based loans yet. What kinds of loans are we likely to foresee them?
Sure, I would see that starting out in the bilateral space. So, a large, sophisticated corporate working with a large, sophisticated bank to do a SOFR-based loan. And I think we'll talk about sort of the structure of SOFR in a bit. Probably wouldn't be an overnight loan, probably be an average, a longer tenor loan that uses an average SOFR. But I could see that being done on a bilateral basis initially, and then a syndicated loan probably late this year, early next year, because we need to have the systems in place to manage SOFR on a syndicated basis.
Gotcha. And Scott, from River's perspective, how are issuers and investors, how are they responding so far in this transition period?
Well, it is slow. Meredith points out that SOFR has only been, it's a new rate, so it's only been in existence since mid-2018. Excuse me. We're beginning to see trading pick up. We're beginning to see alternative products, futures products, cleared products related to SOFR. So as you begin to fill in the data points around the trading behaviors, you're going to develop your curves and predictability around how this rate behaves. Similar with Ameribor, et cetera. You need data, you need information, you need trading on this. So as that develops, people are going to have a better context for how this behaves and what the price they're going to be paying. So that's very important. The other part is making sure that we have enough trading in it and building that liquidity. We are in an education phase right now. We have to continue to talk about the trade itself going forward. We're going to get more information around that. We're going to fill in the blanks. ISDA's working on filling in the blanks around the fallback rate, so you can understand what your back book of business, your legacy contracts are going to be priced at with the new spread methodology. That's an important data point as well, so you can begin to think about how you manage your risk portfolio, what your basis risk, where that exists and how big that is, and how you manage that. So those are all these critical data points that over the next 2 years, we really have to complete that picture so people are completely comfortable with making this transition for the new rate. There's a big discussion around term structures, forward-looking term structures. We need to think about that as well, and I know the relevant risk-free rate working groups are consulting on term structures. I think this is a key issue in terms of getting adoption as well. Now, the other part of this is derivatives is a global market. This is not only happening in the United States. There are many other jurisdictions all throughout Asia. The UK has their effort. The European Union has their effort, all moving to different rates, but similar attributes consistent with the IOSCO principles that Brian mentioned. So we have to bring everybody along in a very consistent fashion to really fill in the blanks and understand how complete capital markets are working, because these are the derivative markets are global markets, and we need to really make sure that we have complete alignment there.
Richard, I'm sorry.
Yeah, I just wanted to make the point that the financial innovation is much like industrial innovation. We started the PC or Apple in 75. It wasn't used in journalism schools until the early 80s. My experience plus a study of history suggests that this is a 15-year process. So the first 2 years could be likened to a toddler, okay?
Terrible twos?
Terrible twos, there's bumps and grinds, and the baby, looks a little drunk and reaches, for something. And 2 to 5, call it, kids and teenagers, and 5 to 15, adulthood. So SOFR is doing very well when looked at in that time. There's 100,000 open contracts at the CME, and that's remarkable for a new product. So we really have to say and focus that this is going to be like any industrial innovation. It's a 20-year adoption. It took 20 years to go from the PC to the web. It took the birth of the web in the mid-90s to another 12 years to get to the iPhone. These things have got to be viewed in a perspective, and I think the early grades for these new benchmarks are quite good, and SOFR's doing a good job, and we should recognize, and we do in our own case, this is not overnight an invention occurs and boom, you've got first movers like Tom, you have fast movers, fast followers, then you have slow followers, and then you have the people that I'd rather die than change, right? This happens all the time.
Just in terms of going through those early parts of development, we did have a volatile stretch in January, and Brian, I was going to ask you how, when something like that happens, how participants, how they react to that. Does it change the discussion? Does it change people's commitment to SOFR or to any rate? What did you take out of that?
So just to comment, I think quickly on the current discussion reminds me of a quick conversation that I had 2 days ago with Mike Milken. We were talking about farmers and ranchers and their uses of derivatives, and how some people may not know this, but the committees in Congress that oversee the CFTC are the agriculture committees, because of the history of futures contracts in the agricultural space. And we were talking about how sophisticated farmers actually are at understanding the use of derivatives. And the answer to the question of how many farmers understand derivatives, the answer is the successful ones. And I think the same thing is true with banks understanding the need to move off of LIBOR. How many banks understand that they need to move off of LIBOR? And the answer is the successful ones. So I think there's a acknowledgement, at least up here, that this is something that is happening, and there's a lot of thought being put into it. Whether or not that's going to proliferate out, I certainly hope so, but I think the success of the firms that do it early will be proven. In terms of the volatility, I think it's important to remember what a benchmark is. A benchmark is supposed to represent something. And if what it's representing has market volatility, then that benchmark should probably have market volatility. If what it's representing is something that's meant to be stable, from a hedging perspective or an exposure perspective, then it too should be stable. So just the fact that there's volatility doesn't bother me. In fact, I will always fight actively a government trying to control volatility in the market from a market perspective. That's not the appropriate role of government. But I think it's interesting to note where that volatility, from where it may have come. And the answer is that it could have come from regulatory constraints. and that there are calculations, including in the supplemental leverage ratio, that are done in some jurisdictions at the end of months that constrain these markets and that could be contributing to that volatility. And if regulations are inadvertently causing that volatility, then I think that is an extraneous factor that is limiting the ability of anything to correspond to the underlying market for which it is supposed to be used. So I think there's something that needs to be thought about there if that is the case. But the second issue is that the way SOFR is actually calculated is that it's a 30-day average. So there is some smoothing there. It's not going to spike, in conjunction with a one-day spike in repo activity. And so, what I care about as a regulator isn't necessarily volatility. It's that a benchmark represents what it is supposed to, and that it is not readily susceptible to manipulation and is based off of robust price transaction data.
I'd actually like to expand on that a little bit from the cash markets perspective, because when SOFR did spike, we got a lot of incoming questions. So to give a little bit of context, the overnight SOFR spike, so over 3 days, SOFR went up nearly 70 basis points, overnight SOFR. But nobody is pricing a loan off of one night's overnight SOFR. That's not how the cash markets will work. So as an example, what you would typically use in a cash market is something similar to 3-month LIBOR. You'd use basically a 90-day compounded SOFR. If you use 3-month compounded SOFR, the rate did not increase 70 basis points, it increased 3 basis points. So again, that volatility, yes, you could observe it in the overnight rate. It is not something that would apply to anybody's cost of funds if they were borrowing off of that. Moreover, and I totally take Brian's point that the point of SOFR is not necessarily to be stable, but one of the things that we have observed, if you start comparing 3-month compounded SOFR to 3-month LIBOR, actually 3-month compounded SOFR is less volatile than 3-month LIBOR. So again, coming back to the cash markets and how people would use that as a cash benchmark, it doesn't exhibit the same volatility that overnight SOFR does.
Are there, we did joke about the sort of the Y2K phenomenon, and obviously ultimately everything was fine, right? But are there holdouts? Are there those that institutions that don't want to move away from LIBOR, that are kind of waiting and to do anything, and in the hopes that there'll be some sort of
Deus ex machina.
Yeah, that will keep everything the status quo.
Sure. Yes. Certainly, we've been going out, seeing many of our members, and a lot of people are just like, this is so terrible, it's so big and so complicated, it can't happen, it won't happen. And they sort of close their eyes and put their fingers in the ears and say, this will not happen, but it will. So that is fundamentally a problem. We're trying to go out and educate people and say, you can wish that LIBOR is not going to end all you want, but that doesn't make it a reality. So let's put wishing aside, and let's think about what people actually should do. And we recommend that they do 5 things. The first is know their exposure. So this is very important, frankly, for the people in the room, for the people watching this on film, as well as bankers, borrowers, et cetera, because we're all exposed to LIBOR. If you've got a credit card, you're exposed to LIBOR. If you've got a floating rate mortgage, you're exposed to LIBOR. If you've got student loans, you're exposed to LIBOR. It's actually very helpful for banks, borrowers, and frankly, everyone in the world to know what their LIBOR exposure is. The second thing is it's important to understand what might replace LIBOR. So we've talked about Ameribor, we've talked about SOFR. There are a number of potential replacements out there, and understanding how they're similar or how they're different, I think, is very important, because they will behave differently in the future. The third thing that's critical, and this is more going back to the bank and corporate lender perspective, is something that Scott mentioned, which is know your fallback rate. So what is a fallback? A fallback is simply contractual language that said, if LIBOR went away tomorrow, to what rate would my loan, my bond, my swap, to what rate would it fall back? And the answer is generally terrifying. If you are a floating rate note and LIBOR went away, ultimately you're just going to fall back to the last quoted LIBOR. So now your floating rate note has become a fixed rate note. You might be doing well, you might be doing badly, but you now have a fixed rate note. If you have a corporate loan and LIBOR goes away, you fall back to prime ultimately. Now prime, I checked it this morning, LIBOR right now is 2.6%, prime is 5.5%. Suddenly your cost of funds is up nearly 300 basis points. That is not good. That is like having 6 rate hikes in your cost of funds. So know what your fallback rate is. Some contracts actually don't say anything. They don't even reference what happens if LIBOR goes away, and all of a sudden you have contracts that don't work. So it's very important that people understand their fallback language, and that's what Scott was referring to, and one of the things that we have been working on a lot in the cash markets. Beyond that, then now we begin to get into what the financial systems need to do. They have to build systems that can handle the new rates. Ameribor looks and feels a fair amount like LIBOR, so I think most systems can handle that pretty well. SOFR is different. That needs to be built out. And then the fifth thing we really, really, really need to do, and I commend Tom for doing this, is we have to start issuing new notes, new bonds, new loans on the successor rates, because what we want when LIBOR goes away is not to have that many loans on LIBOR. So kudos to you for doing Ameribor loans, because we do want to get off of LIBOR.
Meredith, just in terms of the fallback rate, how will disputes between borrowers and lenders play out?
Yeah,
because obviously, if you know, in that scenario you described, you know, you could see borrowers say, well, wait a second, I don't want my borrowing costs to jump like that, and you could see the lender saying, well, that sounds great, right? So how do they?
Right.
how
Well,
do they
lenders
get those?
usually aren't that mean.
Right. No, but there seems to be
Right.
incentives to.
So let's break it down, because I think one of the things we want to do is we want to get to the point where we're not being contentious and litigious. Like, that's the goal, to shrink that pie down as much as possible. So what we're doing in the cash space for fallback language is we are trying to actually really push people in their new loans to put in fallback language that is fair and balanced. So we've created a number of mechanisms that allow borrowers and lenders to talk to each other through an expedited amendment process to get a better fallback rate, or actually hardwire something that, while based on SOFR, is economically very similar to LIBOR. So we're trying to fix it that way. But there will be people that have contracts outstanding that are not fixed, and LIBOR will end and they will fall back to prime. And that is what they contractually agreed to do. So I don't know that there's litigation there. That is
Okay.
what their contract says. I do think people will be fair and say, okay, that is not a great solution. So I think borrowers and lenders will come together and try to amend and fix that credit agreement. The problem is that if LIBOR goes away, it's not just going to be one borrower and one bank that wants to fix it. There's going to be like 10 or 20,000 of these loans outstanding that need to be fixed at the same time. So it's actually, even if people have the best of intentions to fix it, just the backlog will be very high.
Gotcha.
Justin, on that point, derivatives has a slightly different path to amending its fallbacks. A little easier, but again, the size is bigger and it's on a global proportion here. So we're able to publish what a definition of an interest rate is, and in that we would publish what a floating rate note is and what the fallbacks could be. So in the process right now, we have been consulting with the market. We're about to release another consultation in the market around this fallback language to develop some methodology between LIBOR, which is in the contract today, and the new risk-free rates. We want broad market consultation so everybody's involved in this, and we have universal uptake. Because when we adjust both the definitions and establish what we call a protocol, which is a single document that everybody can adhere to that will agree to amend all their existing legacy contracts. We want to put that in place so we get the broadest uptake possible and are able to change all of those contracts by reference of this protocol or definitions.
And I'm sorry, in terms of if there are contracts that are not renegotiated by the deadline, what happens to them? Is there a fallback
There are
written
fallbacks
into
within
law?
it, as Meredith pointed
Yeah,
out.
the same.
But sometimes it could fall back to, you go through something that's unacceptable at this point. This
Gotcha.
is never really considered carefully in many cases because it wasn't likely to happen.
Sure.
So now this has been an eye-opening experience. We have to think about how we're going to adjust to this and protect ourselves, because the last thing you don't want is thousands of people, thousands of entities renegotiating, all trying to do something different. So we want to develop a strategy now that protects from that crisis happening.
I should ask, because we've spotlighted two alternatives. Are there others, maybe in other parts of the world, that will have will have a meaningful share of contracts and of loans?
Well, there are different strategies being employed. Common throughout Asia, for example, is a multi-rate approach, upgrading the existing LIBOR equivalent and then also establishing a new strategy. Hong Kong, Singapore, Australia, Tokyo, Japan, all have kind of a multi-rate approach. So they're trying to keep options available, and that makes transition a little different, but the goals are all the same. You know, making sure that the existing LIBOR is robust, transparent, transaction-based, and then you have alternatives as well.
Gotcha. And again, Brian, you touched on this a little bit earlier as well. As we get closer to the deadline, even beyond that, what role do you think regulators should play in that period in terms of guiding the process?
So I think there's clarity that we at the CFTC could provide, and I need to just only speak on behalf of myself since we're a commission structure and we act on a majority basis. But there's an open question around what constitutes a new swap versus a legacy swap in terms of the avalanche of regulatory obligations that fall down on new swap activity, from clearing requirements and margin, business conduct, record keeping, real-time trade reporting, you know, a very extensive, exhaustive list of obligations. And what I don't think we want is to consider amendments to legacy swaps to move off of LIBOR, which we want, be penalized by rigid or strict or, you know, non-appropriate interpretations of our authority. So I think that there are ways that we can provide some regulatory clarity that amendments that change an underlying reference rate in this vein and capacity don't necessarily trigger the transition of a legacy swap into a new swap and then that entire regulatory suite of obligations.
That's right. And I guess the other question, again, we were talking about different rates for different institutions. Why not have multiple rate options? What's the drawback? Is there one?
Well, I think freedom of choice is a good thing. Yeah. But I do think there will be naturally, I think a lot of people will introduce new rates and some will work and some won't, and that's great, and that's capitalism. That's a market. That's fantastic. I do think there will be some convergence and consolidation into rates for a couple reasons. One, like if you are a big bank and you're managing all sorts of different portfolios and you need to hedge your portfolios, it's helpful that your assets and your liabilities are more or less on a same rate or a correlated rate. Like I think that's very helpful. If you're a borrower, and again, you want to hedge your rate, you're going to want to hedge in the cheapest market possible. That's probably going to be SOFR because that's where most of the derivatives are. So I don't think there's any suggestion that there should not be multiple rates. In fact, I think there should be multiple rates. But I think the idea that there may be costs and benefits to different rates and people will go to the rate that works best for them.
Gotcha.
I think Meredith nailed it. Whether you take hard red, which is a bread wheat, soft red, which is a cookie wheat, or spring, which is a pasta wheat. The question is, for those of us who are participants, is the basis risk, cheaper than the flat price risk? And people make those decisions all day long, and it works phenomenally well. We find an exporter that might hedge in soft red wheat and then move it to hard red wheat as it goes along. So it's not as if all of these are novel problems. People have been examining, and the commission looks at, and the regulators look at, and people who are in the trade look at flat price risk, basis risk. And the idea, for those of us who are practitioners, is to create markets which minimize transaction costs for risk transfer. That's what we do for a living. How do you design something that gives, whether it's Tom Broughton or J.P. Morgan, less basis risk than they would have by not hedging or using a different instrument? And we're accustomed to doing that. You know, it's not as if this is something novel. This has been going on for centuries, and it's worked very well.
I agree with Richard's point, but financial markets don't have the delivery issues that wheat has, right? Or oil has, right? So these are regional markets, and physical characteristics or properties of wheat versus in oil, but these are physical products versus financial products, right? So LIBOR became a global benchmark, right, in the different currencies, et cetera, because it doesn't have delivery issues. It doesn't have characteristics of heavier sweet crude, right? These are financial, these are things that appear on a screen and can be transacted. So, but to Richard's point, we definitely want to wring out the inefficiency or the friction associated with the basis, right? We want to have a predictable rate. We want to have it predictable against different benchmarks that you're using or funds that your loans are in or your hedging tools are in. So we want predictability and clarity. And I think once we begin to have that with trading behavior, that's going to fill in all those blanks. You'll get that predictability, and I think you'll settle into the use of these new rates in a quite effective way.
I do want to leave a few minutes for questions from the audience. First, though, I hope we could kind of look out to January 1st, 2022, and maybe make some predictions about how ready we'll be for this transition, and versus where we'll still have potential trouble spots that could emerge. Maybe Richard's going to start from you, and we'll kind of make our way down.
I think it's going to be like Y2K. You're going to get there, and there's going to be no there. That everything will have been worked out. The banks that survive, I think, as Tom, the successful banks will have made it through the transition. As in any change, there will be some accidents and some people not prepared to do the change, but I see this is ultimately January 1st, 2022. The headline is much ado about nothing.
Which will be awesome, but will be kind of aggravating since everybody's been working really hard to get to
But
that
that's
non-event.
the proof, isn't it, Meredith? Because the job will be well done.
Right.
When there is no aftermath,
Exactly.
right? And all of the work that everybody here is doing will reflect that. There will be, loads, in my opinion. You're going to have SOFR and Sonia and Toner, and you're going to have basis risk. It'll be like in the 10-year, people will be hedging mortgages in a 10-year contract, and they're going to be reaching out for where the transactions costs are cheaper for transferring that price risk, and where are they transparent, and where are they governed properly by a federal agency that eliminates spoofing, all kinds of technical issues, so that the big banks and the little banks feel, okay, this is great, it's been taken care of, and Tom can run his business and continue to lend to companies who need capital, and do it with the least costs. I mean, all we're trying to do here, as we do in all markets, is tighten the bid-ask spread. That's the name of the game. And if you can tighten the bid-ask spread, then we've done our job.
Any other fearless predictions for us?
Well, I tend to agree. I think you may see LIBOR continue to be published, but I think you will probably see, and I'm not necessarily saying I'm advocating for this, but you will probably see regulators refuse to recognize it, that it will no longer be considered an active market and therefore cannot be considered as a benchmark. So for that purpose, it will go away as a reference rate. But that you will also see, in my prediction, you will see more than one rate have derivatives products. You will see, well, I would like to see robust liquidity in at least some of those derivatives products. The path of growth of that of the open interest, and the volume of the SOFR so far has been impressive. It started out better than when Eurodollar futures were originally launched. And it's been doubling every 3 to 4 months. I think you may see some legacy cash contracts not change over, but I think that will at that point be, it won't be for a lack of being well informed.
Scott?
We're going to do everything possible to make sure that we have those fallbacks in place in 2019. So by 2020, we'll have fallback language that you can amend your contracts with, you can integrate, and you can begin adding to your future flow book, whether you trade LIBOR in the next couple of years or the new risk-free rates, but your fallbacks will be robust. We get that nailed down by 2020, people can make that adjustment. We're in a much safer place. Then it's about doing the transition work to begin increasing the trading in all of the viable benchmarks, and then adjusting your systems. Meredith touched on that. The systems adjustment and the trade itself will really be a 2020, 2021 focus for us to make sure that the industry is ready in that regard. And then by 2022, hopefully it's much ado about nothing.
Right. Well, I think the original question when we were talking on the phone was, where do we predict we will be in January 1st, 2022? And if all goes well, beach in Hawaii. But where do we think the markets will be? Where will we be with LIBOR? I could actually see an 80-20 situation, which is 80% of people in my space are doing well and 20% are not. So let's break that down. Of that 80% that are doing well, hopefully 30% of the overall market has already switched to the new reference rate. They're done with LIBOR. They've got SOFR or Ameribor or whatever in the documents, and LIBOR ends and they just go to the new rate. Nothing, it's already in the documents, it's no problem at all. Perhaps 50% of the market hasn't just transitioned and starting to do loans on SOFR or Ameribor, but that 50% has put in really good fallback language. So when LIBOR goes away, they either use the amendment approach or preferably this hardwired approach that automatically switches them over to SOFR, and they don't have a problem. So that would be great. But then there'll be that 20%, the ones that we talked about, who just are kind of ignoring the LIBOR problem or are in a situation where they can't amend their documents or fix things now. And those people may be in loans that go back to prime, because that's what their documents say. And suddenly they're going to have have a larger cost of capital. They're going to be scrambling to amend their documents, and that is not going to be great for them. I think they'll get through it. I think most of them will get through it, but I think that's not ideal. So hopefully 80% of the market doing great. 20% of the market may struggle at that point.
Gotcha. And Tom?
A big part of my business is banking trial lawyers. They're the most enterprising people in the world. There will be a lot of litigation filed over all of these contracts, somebody that feels like they got the wrong end of the deal. Mm-hmm. So it'll probably go on for the next 20 years, in my estimation. They're very enterprising people, trial lawyers.
Very good, very good. I think we have maybe a few more minutes for any questions folks have. Yes, Rodney.
Hey, I've got two, if you don't mind. Steve Kudenholt from Denton's, know some of you. So first is term SOFR. I think the current trading volume, daily trading volume in SOFR derivatives is now, in the 60 to 70 billion range, I think. Why can't the production of term SOFR be accelerated? Because if someone wanted to actually implement term SOFR pursuant to a fallback and create the systems to do that and everything, they would need a lot of lead time. The scheduled creation date, end of 2021, doesn't really do that. But can that process be accelerated?
So I can talk a little bit about how we're looking at this in the loan space, which, Steve, I know you focus on a bit. So I would break down term SOFR into two components. Can you build term SOFR? And can you build an IOSCO-compliant term SOFR benchmark? So two different concepts. Term SOFR can be built very quickly, and I think you will see an indicative term SOFR come out this year so that people can become comfortable and understand what term SOFR looks like and feels like. So I think that's issue number one, and I think that will actually be published relatively soon. The second part, the IOSCO-compliant, do you have something that's sturdy enough that can be a long-term benchmark that is term SOFR? Could take a longer period of time, and I think that's why that's more of a 2021 event. As far as building it into systems, that's something that the ARC Business Loans Working Group, and particularly our operations subgroup, is working on very aggressively. We have gone out and determined that there are 4 potential SOFR rates that we may need to build. Forward-looking term SOFR, SOFR compound in advance. Both of those kind of look like LIBOR and actually can be operationalized rapidly. SOFR compounded in arrears, which is what the swaps market is doing, which is actually fairly complicated for the loan space, and simple daily SOFR in arrears, which look different, and you're accruing interest across the life of the loan. The strategy in the loan space, at least, is to say, okay, I need to operationalize all of these so that when LIBOR goes away, I could fall back to any of them. So that's the strategy that we're doing in the loan space.
And I think the official sector is consulting on that to make sure that you do get consensus and broad adoption. You want to make sure it's IOSCO compliant. You have observable rates. It's not in something that you don't see. You can see on a screen. The other element to that is aligning the fallbacks. We're not real wild about having a variety of fallbacks. We're okay with having a variety of benchmarks, but not a variety of fallbacks, because then it makes the application completely inconsistent, and you're not exactly sure how you're going to fall back and what the ramifications to the market are. So we are looking in terms of a historic fallback rate to make sure that's consistent across all jurisdictions. It just makes that process a lot easier and more reliable.
I'm sorry, we're going to have to wrap things up. Thank you, everyone. Thank you for the panelists for joining us, and thank you for hearing us out here. Have a great rest of your conference.
Thank you.
Thank you, Justin.
Thank you.
Thank you.